Stop what you're doing right now. This is not just another market update. This is a financial crisis unfolding before our very eyes. It is Thursday, January 22nd, 2026, and major banks are on the brink of bankruptcy because they cannot cover their massive silver short positions. The paper silver market, long propped up by complex financial engineering and naked short selling, is unraveling. This threatens to trigger a cascade of defaults that could shake the entire financial system to its core. These banks have sold promises they simply cannot keep. They've issued contracts for silver they do not own and cannot possibly deliver. As physical silver supplies dwindle and global inventories hit critical lows, the pressure to cover these shorts is mounting to a breaking point. When the music stops, and it will, those holding these massive short positions will be forced to scramble for physical metal that just doesn't exist. This isn't some distant possibility or a what-if scenario. It's happening right now. The risk of a catastrophic short squeeze and the subsequent bankruptcies is real and imminent. If you think the silver market is just another niche commodity story, think again. This is a systemic crisis with the potential to wipe out billions, even trillions of dollars, and completely redefine the rules of investing as we know them. The clock is ticking. The real question is, will you be prepared when the banks finally fail to cover their shorts and the market explodes? Stay with me, because I am about to show you the evidence that a major financial event is not just coming, it is already here. To truly grasp the looming crisis in the silver market, you have to understand the mechanics of short selling and the critical difference between covered and naked shorts. Short selling, in simple terms, is a trading strategy where an investor or a large institution borrows an asset, like silver, and sells it on the open market. They're betting that the price will fall. The goal is to buy back that same asset later at a much lower price, return it to the lender, and pocket the difference as profit. This practice is common in many markets and, when done correctly, can provide liquidity and help with price discovery. A covered short means the seller has actually borrowed the physical silver or has a legitimate claim to it. This ensures they can deliver the metal if the buyer demands it. This is a standard and legal practice that helps balance supply and demand in a healthy market. However, a naked short is a completely different beast. This occurs when a seller shorts silver without borrowing or securing the physical metal first. In other words, they are selling contracts or mere promises for silver they do not own, and most importantly, may not be able to deliver. Naked shorting is highly controversial and often illegal in many markets because it can drastically distort prices and create an artificial supply that doesn't really exist. In the silver market, naked shorting has been rampant for decades. Large banks and financial institutions have sold far more paper silver contracts than the actual physical silver available in all the registered inventories combined. This practice inflates the paper silver market, artificially suppresses prices, and creates a dangerous and growing disconnect between the price of paper silver and real physical silver. So why do these shorts exist in the silver market? Well, traders use them to hedge against price declines, speculate on falling prices, or manage risk in complex portfolios. Banks and dealers also use short positions to provide liquidity and facilitate trading. However, when these short positions become excessive, especially the naked ones, they create massive systemic risk. The problem explodes when the physical silver supply tightens, and all those short sellers are forced to cover their positions by buying back silver. If there isn't enough physical silver available to buy, a short squeeze occurs. This forces the shorts to buy at rapidly rising prices, which can trigger a market explosion that feeds on itself. Understanding these dynamics is absolutely crucial to recognizing why these uncovered silver shorts pose such a significant threat to the market's stability, and why the current situation is so incredibly urgent. The fragility of the silver market is largely due to the enormous short positions held by just a handful of major banks. Recent data reveals a precarious imbalance that threatens to trigger a full-blown crisis. According to the latest delivery reports from the COMEX Futures Exchange, these banks collectively hold hundreds of millions of ounces in short contracts, far exceeding the physical silver that is actually available for delivery. And one of the most revealing metrics to watch is the daily delivery report. This tracks how many contracts are standing for physical delivery and, more importantly, which institutions are issuing or stopping those contracts. Recent reports show something astonishing. On a single day, a major bank like JP Morgan has been seen stopping over 98% of all delivery notices. This means they are acting as the primary buyer, taking in almost all the physical silver being delivered onto the exchange. Meanwhile, other banks, such as Bank of America, are issuing a large number of delivery notices. This indicates they are the ones desperately trying to source silver to fulfill their short obligations. They are on the selling side, trying to find metal to deliver. The sheer volume of these short positions is staggering. For example, JP Morgan's short position has been estimated at over 100 million ounces. That figure alone dwarfs the registered silver inventories on COMEX, which currently hover around a dangerously low 120 million ounces. This means that a single bank E or S short exposure is nearly equivalent to the entire physical silver supply available for delivery on the world's primary exchange. This creates an incredibly dangerous imbalance. Moreover, the open interest, which is the total number of outstanding futures contracts, has surged to record highs. A significant portion of this is attributed to the short positions held by these very banks. This concentration of shorts in just a few institutions amplifies the systemic risk, as any attempt by them to cover these massive positions could completely overwhelm the market and send prices into orbit. The delivery reports also highlight another alarming trend. The number of contracts standing for delivery in typically quiet, non-delivery months has spiked dramatically. This signals growing, intense pressure on these banks to fulfill their physical obligations. This surge isn't just a routine market adjustment. It reflects a run on the physical silver supply that the shorts are legally obligated to cover. In summary, the size and concentration of short positions held by major banks are completely unsustainable. The data paints a clear picture of a market teetering on the very edge. The inability of these institutions to cover their shorts could trigger a chain reaction of defaults, bankruptcies, and a historic short squeeze that sends silver prices soaring to levels we've never seen before. So, what does all this mean for you? It means the foundation of our financial system is being tested. The value of paper assets is being questioned, and the true value of real, tangible assets like silver is about to be revealed. The disconnect between paper promises and physical reality can't last forever. As inventories are drained and delivery requests intensify, the day of reckoning for these over-leveraged banks is fast approaching. And this isn't just about making a profit. It's about protecting your wealth from a systemic failure. The signs are all there, written in the delivery reports and the inventory levels. The smart money is already moving, securing physical assets before the panic sets in. The question you need to ask yourself is, will you be caught holding worthless paper, or will you be holding the real thing when the system breaks? This is a critical moment in financial history. The silver market is the canary in the coal mine, and it's gasping for air. Pay close attention to what happens next, because it will affect everyone. What if I told you the silver market is a ticking time bomb, and the fuse is getting shorter every single day? One of the biggest dangers lurking in the shadows is the massive number of uncovered silver shorts held by major banks and traders. This situation is made even more explosive by a simple, undeniable fact. The world is running out of physical silver that's ready for delivery. You see, unlike paper silver, which can be created out of thin air with futures contracts and derivatives, physical silver is a real, tangible asset. It has to be mined, refined, and stored, and you can't just speed up that process on demand. For years, global silver production has been pretty much flat. Mines are dealing with lower quality ore, there are labor strikes, and political instability in key countries like Mexico and Peru is disrupting the supply chain. All of this means less new silver is coming onto the market. At the same time, the stockpiles of physical silver that back the futures market are disappearing at an alarming rate. The registered inventories at COMEX, the main futures exchange, are near historic lows. We're talking about a tiny fraction of the amount of paper silver being traded. Think about that for a second. There are far more promises to deliver silver than there is actual silver in the vaults to back them up. This isn't just a spreadsheet problem. This inventory is being drained by real-world demand. Industries need silver for everything, from solar panels to electronics. Investors, especially in Asia, are buying up physical bars and coins like never before. As this physical metal leaves the vaults, the pool of silver available to cover all those paper promises gets smaller and smaller. This creates a terrifying trap for anyone holding a large short position. They are betting that the price of silver will go down, but if they're forced to buy back the silver they've shorted in a market where there's almost none to be found, what do you think happens? The scarcity alone will send prices into orbit. This is the perfect recipe for a legendary short squeeze. So what exactly is a short squeeze, and why should you care? Imagine a crowded theater where everyone suddenly rushes for a single tiny exit. That's a short squeeze in the silver market. When the price of silver starts to rise unexpectedly, those who bet against it, the short sellers, start to panic. They sold silver they don't actually own, and now they have to buy it back to close their positions and cut their losses. But here's the catch. They all need to buy at the same time, and they're all chasing a critically low supply of physical metal. This frantic buying frenzy creates a powerful feedback loop. The more they buy, the higher the price goes. The higher the price goes, the more other short sellers are forced to throw in the towel and buy back, pushing the price even higher, faster. The result is a violent, explosive price surge that can happen in the blink of an eye. This is where the paper market completely breaks down. When short sellers can't find enough physical silver to deliver on their contracts, we get what's called a delivery failure. This isn't just a minor inconvenience, it shatters confidence in the entire system. It proves that the paper promises were hollow all along. The consequences can be catastrophic. Banks and trading firms with huge short positions could face unimaginable losses as they're forced to buy silver at astronomical prices. If they can't meet their obligations, they could go bankrupt. Given how interconnected our financial system is, the failure of one major institution could trigger a domino effect, creating a crisis that spreads far beyond just the silver market. For everyday people, this could mean that your paper silver contract becomes worthless. You might be forced to accept a cash settlement that is far below the true price of physical silver, or you might find it impossible to get your hands on the real metal at all. In short, the combination of massive short positions and a dwindling physical supply has created the perfect storm. We're not just talking about a market correction. We're talking about the potential for delivery failures, bankruptcies, and a complete reset in the price of silver. The instability is built into the system, and it's only a matter of time before something has to give. The silver market is teetering on the edge of a massive crisis. And if you're holding paper silver, you need to hear this. What's happening right now isn't new. History is littered with examples of commodity markets blowing up, and silver could be next. Let's rewind to 1980 to an event called Silver Thursday. The Hunt brothers tried to corner the market, buying up so much physical silver and futures contracts that they drove the price from $6 an ounce to nearly $50. But then, regulators stepped in, changed the rules, and the whole thing came crashing down. It was chaos. This showed just how fragile paper markets are when physical supply gets tight. Then you have the 2008 financial crisis. While not just about silver, it exposed huge cracks in commodity markets when delivery failures and cash shortages hit. It proved that a crisis in one part of the financial system can easily spill over and wreck everything else. And who can forget the GameStop saga in 2021? A group of retail investors coordinated their buying, squeezed the short sellers, and sent the stock to the moon. The mechanics are the same. Limited supply, a ton of people betting against it, and a wave of panic buying. Today's silver market has all the same ingredients. We have banks with massive short positions, betting the price will go down. At the same time, physical silver inventories are at historic lows. This is the perfect storm. These historical events are not just stories, they are warnings. They show that when a market finally breaks, the move is fast and unforgiving. So, what does this mean for you? If you're a retail investor holding paper silver like futures contracts or ETFs, you're in a dangerous spot. You have a claim on silver, but you don't actually hold the metal. The biggest risk is the growing gap between the paper price and the price of real physical silver. Imagine this. The supply of physical silver dries up completely. The banks and institutions that sold you those paper contracts can't deliver the actual metal. In this scenario, they might just settle your contract in cash. But here's the catch. They'll pay you based on the manipulated paper price, not the soaring price of physical silver that everyone is scrambling to buy. You could end up with a fraction of what your investment should be worth. On top of that, as this crisis unfolds, the premiums you pay for physical coins and bars will skyrocket, and it'll become almost impossible to find any to buy. Even the big players, the institutional investors, are at risk. Hedge funds with large paper positions could get wiped out by a sudden short squeeze. If they're forced to cover their short positions in a market with no physical silver available, they'll face massive margin calls and catastrophic losses. The fact that a few big banks hold most of these short positions creates a systemic risk that could shake the entire financial system. Let's be clear, the silver market isn't a simple investment anymore. The old rules don't apply. Relying on paper silver without a plan to get your hands on the physical metal is a huge gamble. You're trusting that the other side of your contract will be able to deliver in a market that's showing every sign of breaking. The risks of just sitting on paper assets are growing every single day. You need to be smart, understand the difference between paper promises and physical reality, and prepare for some serious volatility. So let's bring it all together. The silver market is facing a crisis of epic proportions. Major banks are struggling to cover enormous short positions as physical supply disappears and demand goes through the roof. The gap between the price of paper silver and real physical metal is widening, creating a trap for anyone holding paper contracts. History teaches us that when markets like this break, it's explosive. Short squeezes and delivery failures lead to chaotic price surges that can happen overnight. The writing is on the wall. If you wait too long, you risk being caught in a market collapse or being forced to accept a cash settlement that is a slap in the face compared to physical silver's true value. So what's the move? The most important step is to prioritize owning physical silver over paper assets. Get your hands on the real thing, buy from reputable dealers you trust, and consider diversifying your holdings with different types of bullion, like coins and bars. Stay informed, watch the market signals like a hawk, and get ready for a wild ride. Don't be the investor left holding a worthless piece of paper. The time to act and protect your wealth is right now, before the silver market makes its next explosive move. Thanks for watching, and be sure to subscribe for more updates.